So last time we met, we started with earnings per share, and you said there are two forms. It's either it is simple or complex. So the simple capital structure contains no potentially dilutive securities. And whatever we mean no potentially dilutive securities, we gave some examples of what they call of capital. One of them is ordinary, preference share, and what they call debenture, and maybe the last one we talked about was treasury stock. So we now said ordinary share. Once you remain an ordinary share, you remain ordinary share forever. Once you remain preference share, you remain preference share forever. Dividends, debenture, you remain debenture share forever. So it depends on which one you are. Whichever one you are, you remain that particular one forever. That's a simple capital structure. While complex capital structure, you can convert from any one of them into ordinary share. Let's say, for instance, now you see that the company is performing very well and you want to enjoy huge dividends and just convert from that. You can't just decide and wake up one day that you want to convert. You have stated it in your contract earlier and you want to convert, and you can convert later on. So preference shareholder, once you see that the company is performing well, they just switch and convert into ordinary share. Likewise, debentures, you have stated in your contract. After 3 years, if I see that this company is performing well, I can convert from debenture holder into ordinary share. So I start making their switch. But we start looking at calculation. What matters to us is this calculation. We've looked at simple capital structure. We've looked at converting preference shares. Okay, so we've looked at that other one too. If you are converting, if you are using a simple capital structure, that one is fine. Now, if you are converting from preference share into ordinary share, we look at that one. So the next one we are looking at now is you converting debt into ordinary share. And I told you that the first thing you need to do is calculate your basic earnings per share, whichever method you are using. Calculate your basic earnings per share. Calculate so you now whichever is lower is your answer. Whichever is lower is your answer. That's what we talk about. Whichever is lower is your answer. So we look at preference stock, converting preference stock into ordinary share, and you all try to solve it properly. The next one is now let's look at how to convert debt into ordinary share. So let's look at this question together. So during 2006, Y Corporation had earnings available to common shareholder of 2.5 million. Earnings is the same thing as profit. So when it's supposed to see earnings, you know that is also profit. And had a 1 million share of common stock outstanding for the entire year of basic. Okay, so you can see that if you help us to compute our basic earnings per share, which is 2.5. Remember I said whenever you say any question that has to do with diluted earnings per share, the first thing you need to do is compute your basic earnings per share. So how did you get that basic? It is your earnings, which is your profit, divided by your weighted average number of shares, which is 1 million. That's why they got that 2.5. So that's fine. So we helped us to compute our basic. The next is to compute our diluted earnings per share. And I told you, please don't cram this formula. It's a waste of time. You can see what they will say. What do you cram the formula? You need to cram. Just follow the rules that we've spoken about. Now, let's continue. So remember we said, now this person is converting into what? Talk to me. Okay, those online, can you see here me? Okay, sir. So I just wanted to confirm if you are with us. So now, next is June 2005. Why issued 1,000 per 5% bond for 2 million? Each of these bonds is convertible to 120 shares of common stock. The tax rate is 30%. Calculate your diluted earnings per share. You try it, but let me give you some hints. So this is it. The company generally believes that if you are borrowing money, because it's not logical to see a company borrow money to buy vehicles or buy cars for top staff, because it doesn't make sense. Look at it, you are a CFO of a company, you borrow money and you are borrowing money to what's it called? To fund, maybe you want to buy an official car for staff. It's not appreciated. You are losing money because you have to pay interest on that money. So if you see a CFO act like that, there's something wrong with that CFO, that company. Because how can you borrow money to probably buy assets that is not going to appreciate? But you buy motor vehicle, you'll be maintaining it and you still be paying interest. So it doesn't make sense for a company. So what government believes is that for you to be able to go to the bank and borrow money, you are probably using that money to buy goods and services for your company. So that is why you see that every point when you see debt or interest expense, once you are paying back interest, there is usually tax in it. Does it make sense? Because they believe that you are going that extra money to borrow money. Are we together? Are we together?
Yes.
Okay. Yes. So that's what they believe. They believe that if you borrow money, why would you borrow money to just go and buy motor vehicle for people? Because it doesn't make sense. So they believe you are borrowing money to probably what? To probably go into maybe fund, buy goods and services that you want to sell and make interest and make profits. So they believe that let them charge you now, and since you are making money on this thing. So that is that one. So how do we now go about this? How do we go about this? The first thing you remember is once you are once you are charging interest, remember there is usually tax on it, because you are paying, you have to pay government that tax money, because government believes that you are borrowing money to probably buy goods and services, so they tax you. They tax you and you collect tax on it. That's why you see when you see interest expense, 1 minus tax. I don't know if that's fine. So the next one we are going to look at is let's look at an hypothetical financial statement. Hypothetical financial statement. Look at it for example. Once you have your revenue, you see your revenue. You put something, you put your cost of sales, you put something, you get your gross margin, gross profit or gross margin, gross profit. Admin expenses, you put this one. Then interest expense, which is under your finance cost, interest expense. Remove it. Then you now get your profit. Do you understand? So this is the profit that ordinary shareholder would talk about, because you paid this debenture holder. So once this person is converting into ordinary shareholder, you have to add this interest back to the profit. Because at that point, you are not paying any interest expense again. Are we fine? Are we together, everybody? So if you are calculating, they are converting a bond into an ordinary share, you have to add your profit, your earnings or profit, plus interest expense. You now calculate your. So this is what I'm saying then. I just wrote an hypothetical financial statement, which is revenue minus cost of sales. So you get your gross profit. From your gross profit, you remove your admin expenses. From your admin expenses, then you remove your interest expense. So to get your profit. So what we are saying is, if the person is converting, before now, interest expense, you have to pay them their finance cost. But if the person is converting, what we will do is, you don't need to pay that person again. You have to pay the person for the profit. So what is that interest expense we initially computed, you add it back to your profit. That's what we are just saying. You add it back to your profit. That's what we are saying. You add it back to your profit. So let's now go back to this our question we solved. You see, we're told that during 2005, why issued 2,000 and 1,000 per 5% bond for million. So each of the bond is convertible to. So we're told that each of the bond is convertible at what? 120. So let's go. How do we go about this? So can you see my screen? Can you see my screen? Okay, where we have convertible debt, Okay, so let's go. So you can see.
Now, for example, EPS converted to debt during 2006.
Yes, that's it. Yes. So let's go. So let's solve it. We already have our basic earnings per share. So the first thing we need to do is let's now calculate our diluted earnings per share. How do we calculate our diluted earnings per share? Remember, what is our earnings? Our earnings is 2.5. At that point, now we are adding back our interest. And this is eventually, we are adding back our interest. So let's add back our interest now. So what's our interest now? We are talking to anybody. We're told that if the bond is convertible at 2,000 at 1,000 per 5% a day. So what you will do is you go somewhere, do 2,000. So you can see now we are calculating our interest expense. Now we say the interest expense, we are adding it back. So it's 2,000 times what is the basis? We are told that it's 2,000 at 1,000. So 1,000, 1,000. Times what? 5% bond times 0.05. Yes, please let everybody try this. So, and remember we said interest expense, you tax it. Interest expense, you tax it. So it's going to be what our tax, it is going to be 1 minus 0.0. Is it 0.03 or 0.3? Talk to me, everybody. What's our tax? Our tax is 30%, so it's 0.3. Yes, thank you. What do we have? We are talking to me. What do we have? When you do this, 2 million times 1,000 times 0.05 into bracket 1 minus 0.3. What do you have? 70,000, yeah. So we'll add back 70,000. So this is the interest the person has been enjoying.
Sorry, what are we adding back the 70,000?
Okay, so that's why I explained it here. You know, yes. So what we are saying is, you deduct interest expense to get your earnings. Yes. You deduct interest expense. So at that point, the person is now converting. Exactly. So that means the person is not enjoying the interest expense. Thank you very much. So the next is our weighted average. Our weighted average, we initially have 1,000, and you can see people who were there before 1 million shares outstanding. So 1 million shares outstanding. Then they are converting. Now see, who are the people converting? During 2005, issued, we told that you convert at that much, the issue is 2,000, you convert at that much, 120, so it's going to be 2,000 times 120. What do we have? That is going to be 240,000. If I'm correct, talk to me anyway. 240,000. So we are adding 240. This person is coming to. So what do we have? What's our diluted earnings per share? What's our diluted earnings per share? Where now? Talk to me now. 2.07. Yeah. 2.07. Thank you. So that is our, you can see 2.07. That's how we got that 2.07. Makes sense, I mean? So that's it. So you don't need to cram any big formula. Just understand the logic and you're able to apply it simply. You understand? Like you cramming formula and you're not able to apply it, it's a waste of time. Just understand the logic and you're able to apply it straight. So let's go. So we looked at preference share, we looked at basic X, we looked at converting debenture also. Now let's look at stock option. If you are converting stock option, how does it go? So basically it is easy. So at that point I used to say that when you are with a company and you are the owner of a company, and you are employed by the owner to manage the company, you can mismanage the company. And that's why there's usually issues, usually trust issues at times. Trust issues between the owners and the managers. The managers can divert the funds of the company to do their own personal business or personal stuff. So what they can do is can align the interest of the owner with the company. How do you do that? You can say, okay, if you perform very well this time around, give you 10% of our stock, which is going to help you towards. So by the time you say that you are collecting 10% of the company, like the example of the probably, and you tell the person, okay, if you get a profit of 70 billion this year, I'll give you 10% of our stock. So instead of the person diverting the funds to other places, you probably divert it to what? You probably divert it to probably the motive of the owner. So that's why you do stock option. So how does it work? How does it work? So let's write this down. If you are giving a stock option, it is usually average market price. That's right. Average market price. Average market price, which is AMP. Minus exercise price. Exercise price divided by what? Average market price. Okay. Times 10, which is number of shares. Average market price minus exercise price divided by average market price times 10. So let's go. So how does it work? Look at this option, look at this. Look at this. During 2006, corporation reported earnings available to common shareholder of 1.2 and had 500 shares of common stock outstanding. So the first thing you need to do, like I said, is to calculate your basic earnings per share, which is your earnings divided by your common stock, which is what is called 1.2 divided by 500. So that's how you go to that 200. Yes, that's how you go that. So the next is that this stock option. How does it work? Now you've been granted a stock option, and the stock option says X has 100,000 stock options warranted outstanding the entire year. The options allows it to its holder to purchase one share of common stock at 15. You understand? The average market price is 20. You look at it logically. If you are buying it outside, it is 20 USD. But because of the agreement you have with the company, they say that they are selling it for 15. Thank you. So how do you go? So you can buy it now. Since they are selling it for you cheaper, so it's going to be your. So let's calculate now. It's going to be average market price minus exercise divided by average market price. So what average market price? 20 minus exercise price 15 divided by what? Average market price. Abi? Yeah. So what do we have? Yeah. What do we have?
0.25.
0.25. 0.25 times 100 is what? 25. Thank you. No, that's C. C. X has 100 stock option. You understand? 100 stock option of warrant.
The X number of stock option.
Yes. No, you can see 100 stock options. The name of the company is X, and it has 100 stock options. Altogether. So The discount they are giving you is what? 25. I don't know if that makes sense, Abi. So normally, if outside person is buying it for 100,000. At 100,000 stock option, you buy 100,000. But you as a staff, they are giving you 25,000 discounts from these shares outstanding, Abi. So you are paying 75. I don't know if that's clear. Are you following me? Everybody?
Yes.
The outside person is paying 100, but because they are giving you as a staff, they are giving you as 75. And so the discount of 25,000, it is the discount that the company will pay for. I don't know if that's fine, but I shall explain again.
The company is paying for the discount only.
Yes, the discount only. So this is it. You go and meet somebody as your friend. I want to buy a recharge card. Recharge card of how much? Recharge card of 100,000. Oh, nice. Because you are my friend, please pay 75,000 naira. You understand? So somebody has to pay for the difference of that 25,000 naira. That's why. Exactly. You are my friend. We've known ourselves for how many years now? Okay. Please pay 75,000 naira. You understand? So it's a discount that the company is paying for. That's 25,000 naira that the company is paying for. So let's go. What is our earnings per share? What is our earnings? Like diluted earnings per share. What is our earnings? Our earnings is 1.2. We are calculating 1.2. I mean 1.2. So it's 1.2. I mean, now what was the initial outstanding shares we have? We have 500. I mean, we have 500. I mean, so now this 25 that this person is paying for. That's what. So how do we now calculate? We'll be able to see 1, 2, I mean, then the 500, right? So the next is what? The next is to get which one now? What did we calculate? The discount, I mean, the initial was 100, I mean, the amount we paid is 100. He's paid 75. So the discount that the company is going to pay is 25. I mean, so let's calculate this. What is our diluted earnings per share? What is our diluted earnings per share? 2.29. And see that's how it goes. So the understanding is that once they pay 100, the company is supposed to pay 100. But because you are my person, pay 75. I mean, we are still paying something. So the discount that you are giving the person is the company that clears it. So that's how they arrive at 2.29 for the diluted expansion. So I don't know, is this something? Let's quickly look at this question. Yeah, fine. Okay, that's fine. So let's look at number 2. Everybody, let's look at this. Let's look at number 2. An analyst has gathered the following information about the company. 300,000 shares outstanding, 100,000 warrants exercisable at 50. Then average market price of 55. Year-end share price is 60. What is the what? How many shares should be used in computing the diluted earnings per share? So what do we think? What's the formula first of all? Average market price. Average market price minus exercise price divided by what's the average market price? What's the average market price? Yeah, now talk to me. What's the average market price? 55. Yeah, what's our exercise price? 50. So if we 55 minus 50 are divided by what? 55. Which is what?
0.09. Thank you. So how do we now go about it? How do we go about it? So the next thing you do is this amount of done. The next thing you do is what is our amount that we want to convert? Which is 100, Abi? So all the total amount the company is supposed, the person is supposed to pay is 100. But how much discount when the person give you? 4, 10%. So what you are saying is 55 minus 50 divided by 55 is what? 0.09. Let's say 0.09. Let's not approximate 0.09. You can put your decimal place to like at least 4 decimal place. You know how to do that, right? You can put it to like 4 decimal place. So what if you put it to 4 decimal place, what do you mean?
0.09090.
Yeah, 0.09090. So multiply it by what's it called? 100. What do you have?
$1.1.
9091. So that's the discount that company is there. So what goes into your outstanding number of outstanding shares? They are talking here. How many shares? So how many shares should you use in contributing your diluted earnings per share? They are talking.
This period is shares. When the shares are standing, use the dilution. The 300 plus the dilution.
Yeah, so we see the 300 plus which one now? 9091. What's our answer? So the total shares they are supposed to use for your dilution that one. That is 300,000 plus that 9091. That's the total shares they are supposed to use for your dilution. That's the total shares they are supposed to use for your dilution. Makes sense, I mean. Okay, so that's basically all. I think we'll see more questions when we get to the curriculum. I'm going to look at the long questions. But that's basically all of the things. So that's the maximum you can ask your basic and diluted. Just follow, you don't need to cram the formula, just follow the rules, they are fine. They are fine. So let's look at ratios and common size income statement. So for instance, now what does common size income statement? From now on, if the stuff is easy, let's just relax and let's just get in just understand what we are talking about here. What does common size income statement? We are comparing two companies. The first one is like a GTP, and the second one is like which microfinance bank or microfinance bank we have that is still small. That people are saying it's okay. Any bank that wants to compare, Abi. Okay, let's look at Kuda. Let's look at Kuda. You compare Kuda or OP, Abi, and the GTP. Some people might say that, oh, Kuda is trying, they have access, they have this, they have that. But the truth is, you can't compare GTP and Kuda. Abi. So for you to compare, now you are doing your analysis, your self as well, you can't do the analysis for now to see which is better. One of the things you can do that eliminates size for when you are doing analysis is common size income statement. Always get them common size income statement. So how do you go about that common size income statement? So let's look at this for instance. Let's say North Co is a GTP. While South Co is what? A Kuda. North Co is a GTP, while South Co is a Kuda. You can see that from their revenue sides, GTP is showing 75,000, while Kuda, which is the South Co, is showing 35,000. Like that, look at that profit. But looking at it from this outside, who do you think is performing better? GTP, Kuda. GTP is North Co, North Co is Kuda, this GTP for this example, while South Co is Kuda. You can say North Co GTP is performing better. But one of the things you can actually do to know which one is performing better is to what? Do a common size analysis. So how do you go about this common size analysis? This what matters for your exam is this now. For a common size income statement, you divide each line item by your revenue. Please let's take it. You divide each line item by your what? Revenue. Yeah. So 75,000 divided by 75,000 is what? 1. 35 divided by 35 is what? 1. 52,500 divided by 75,000 is what? Yeah, help me. Zero point seven. While the other one was South Pole. So we divide it line item by revenue. So 700 divided by 35 is what?
5.
Eh?
5.
Eh? 700 divided by 0 point. You divide each line item by revenue. So your gross profit now, 22500 divided by 75.
Zero point
0.3. How about that one? Are you sure it's 0.3? 225 divided by 75.
Not 5, not 2.5.
22,500, sorry. 22,500 divided by 75. What do we have? 0.3. What about that one? And 2 is divided by
0.8.
0.8. Next one. 0.55.
Last 5.
0.55. What about this one?
0.15.
0.15, shall we? So we can do the other ones like that. So let's just do this operating profit. So what do we have in top?
Is it point 1?
0 point. 0 point. 0.1. What about this one? 0.45. So now let's compare. Which one is better? You can see we can't brought everything to the same level. It's not that you're comparing apples to apples. You can see from South Pole, that means their cost of goods will be able to be effective and able to reduce their cost of expenses to 20% of their revenue. While GTB, they are doing 70% of their revenue. You can see, look at the profit here, gross profit, they are doing 0.8%, they are doing like 80% of their revenue. While look at the GTB doing 30% of their revenue. You can see, so which one is performing better now? Kuda, South Pole. So one of the things you can do to common size analysis. Common size analysis brings everything to level. I mean, that's why we can see not one is South Pole, we can now compare. That's brought everything to the same level. Makes sense. So you divide line item by your. So let's go. That's what you've done for us. You divide each line item by your revenue. You can see. So it's showing that South Pole is better. South Pole is better. In all aspects, South Pole is better. Even their expenses, managing of their expenses, and everything. South Pole is better. Because South Pole is a small company, they are doing a lot of research and expenses. Yes. Their research and expenses is very high, which is 20%. So they are doing a lot of testing, Let's see new thing we can do, new innovation. Unlike the GTP, like the big company, it's just little things they are testing. Are we good? So there are other ratios which we can talk about. We'll talk about the role of these ratios. We'll talk about the role. Basically, net profit margin, anything that has to do with margin, divided by revenue. Any that school is matching the right value. Okay, so that's basically all for your income statement. Any questions? Any questions? Before we move into curriculum questions. Any questions? Any questions? Who has any question for us? So let's quickly run through curriculum questions so that we'll just cement what we answer. If you run through these questions, please, if you have any issue, I'm not sure if you have any issue. I'm not sure if you have any issue. So expense and income are recorded at once. Either what? Nature or functionality. Yeah, we talked about this. An example of expense that by function is what? CFA. I mean, cost of goods sold by function. And you remember, right? So look at this now. When you are calculating your gross profit, what's our gross profit here? What's our gross profit here? 1 million. Okay, good. So you can see that if you try to do your you try to calculate your net profit also, that's how you get. I mean, so one should just be very careful. One should be very careful and know where you are doing very well. Know where you are doing very well. So let's move. Let's see, let me do that. Okay, let's look at number 5. Family had the following information related to sales of its products globally, which was its first year of business. Under how much net revenue we recorded. Net revenue. What's our net revenue?
That was first one.
Yeah?
That was fun.
It's covering its own share. Anything. Net revenue. Yeah. Net revenue.
Let's do it.
What did you get? Let me see what you get. So how do you calculate your net revenue? So how do you calculate your net revenue?
2,000 minus 100.
1,000 minus 100.
7,000.
Okay.
Minus 7.
Minus 7. Where is 7? So you should put your net revenue. So 2 things now. Let's be careful. There is net revenue and there is gross profit. So gross profit is your revenue minus your direct expense. And which is your cost of goods. While your net revenue is your revenue, less discount, less return. So if you are giving anybody discount, you will leave it. If you are giving anybody return, say guys, people are returning, oh, okay, this recharge card is sold for me. They used it to, if you guys are fighting, you shall bring, take another one. That's returns. So then discount, my friend, yeah. So that's okay. Take pay 20%, remove 20% and so on. Do you understand? So once you take a percentage of it, so to calculate your net revenue, it is your revenue minus discount minus what? Minus what's it called? Oh yeah, talk to me now. Minus discount minus what? Returns. So with this, I think that should help. So what's our net revenue? 200. This is 200. Net revenue. No, I said it's gross profit and it's net revenue. Net revenue is your revenue. 900. Thank you, sir. So are we fine? So let's look at number 6 quickly. Before we move into balance sheet. Number 6. Yeah. Apex concerning sales items over the internet. Remember if you are an agent, if you are a what's it called, how much will you charge? You charge the employee commission. But if you are not, you charge the full amount. Agents charge only commission as their revenue and gross profit. Yeah, let's go. So what's number 6? Okay, we all agree. So remember, we only charge commission as revenue. So what you want just for, if this person is agent, what is agent? Charge for commission and let me look for any other one that we quickly look at. Which inventory method is least likely to be used on our
Sorry, that's it.
Yes, least like, not least unlikely.
Okay, this like
Least likely to use IFRS.
it's different.
Before. Thank you. Okay, so these are what basic elements. So let's just do one and confirm. We'll move into balance sheet straight up. Let's do number 18 together. Everybody, yeah, number 18. Number 18. Number 18. Quickly. So what's the limited expansion? Number 18. I'm waiting, let's choose the answer. I'm waiting number 18. Then we know that we are fine. So at that point, what's the first thing we need to calculate your basically? What's our basic? The calculation of the limited expansion. What's our basic earnings per share first? What's our basic earnings per share? 4. Okay. Now let's do what's our diluted earnings per share. Let's all try it. Let's also there's issue. Let's all try it. What's our diluted earnings per share? Eh? 3.52. So how do you get 3.52? Why do you get 3.52? How do you get 3.52? No, don't be proud of me. Okay, yeah, let's go now. So this is it. We've gotten 4. So there are 2,000 convertible shares, I mean. So let's see, how did you get that for first of all? So the number is what? You have, let's do it this way, 200 million, Abi, divided by weighted. So we said this is you can enjoy the preference dividend with Abi, which is going to be 2,000 times 5, Abi. That's the dividend the person will receive. So 2,000 times 5 is what? Oh yeah, no, 2,000 times 5 is what? Eh? 2,000 times 5 is what? That's 10, Abi. 10 million, So it's going to be your basic earnings is going to be 200 million minus 10 million divided by weighted average of 50,000. So what do we have? 200 million minus 10 million divided by weighted average of 50,000 common shares. What do we have? 3.6. 3.6. So that is our basic earnings per share. Now let's calculate our diluted earnings per share. So at that point, you are no longer enjoying the benefit of the preference dividend in you are no longer enjoying the benefit of the preference dividend. Now you are converting into what? Into diluted earnings per share. So at that point, the preference dividend will be off. So our net income is going to 200 million divided by what? 50,000. Is it 50 million or 50 million shares plus now we have 2 million convertible and 2 shares so it's going to be 2 million times 2 which is 4 million so it's going to be 200 million divided by 50 million plus 4 million. So what do we have? Everybody now is higher. Let's consider this. So what do we have? 3.7. So that's our diluted earnings per share. That's our diluted earnings per share. So is that clear to everybody? Are we fine? Are we fine? So let's go. Okay. So now, balance sheet. Let's focus on balance sheet. So, what's balance sheet? When we started, we said we're going to talk about 5 main groups: income statement, balance sheets, statement of changes in equity, which one again? Cash flow and notes. We look at income statement, if we are on balance sheets now. So what's balance sheet? What's balance sheet? What do you understand by balance sheet? Well, now talk to me. So some people can say balance sheet is where we record our assets, liabilities, and equity, and we have different forms of assets: non-current assets, current assets, non-current liability, current liability. So what are assets? Assets are basically what the company owns. What belongs to the company? What the company owns? What belongs to the company? Like for instance, you bought a motor vehicle for the company as well. So what the company owns. While so what we say non-current assets are assets above 1 year. These are assets above 1 year. When we say current assets that are expected to that is less than 1 year, 1 year and less. That are expected to finish its useful life within a period of 1 year. Are we tired? So it is tired. So current assets are assets that are expected to finish its useful life within a period of 1 year. So if you are an analyst and you are analyzing the financial statement, you're analyzing the financial statement, and you see that there is this current asset that keeps that is more than 1 year. It's a red flag for you. It's a red flag for something you pick up and say, why please explain why this current asset is above 1 year. It's a red flag. Like you say, see if you don't, it's not teaching you to become an accountant. Wear the cap of an accountant and see the way they think. That's what it is for. So that is non-current asset. The next one is what? Non-current liabilities. These are liabilities that goes above 1 year. Liabilities, obligations you have to settle that are above 1 year. While the next one is the current liabilities. These are liabilities that you have to settle within a frame of 1 year or less. Equities are what? Are the residual or the amount the owner brings into the business. For instance, now you feel like, this company is not performing, but let me bring a certain amount of money to boost the performance of the company. That is equities. So let's go. So let's talk. So what are the advantages and disadvantages of balance sheets? What are the limitations of balance sheet? What are the limitations of balance sheet? Who wants to try? One of the first limitations of balance sheet, once we even start to see, one of the first limitations of balance sheet is that balance sheets on its own generally some items.
I have a good question. Investment within 12 months. Where will it be?
So investment within 12 months to be under current assets. So like I said, any assets that are above 1 year is not current asset. One asset below 1 year and less is current asset. So if you are investing in short-term investment, like investing in treasury bills, mutual funds, you put it under current asset. And we don't have cash and cash equivalent, or maybe your fund, depending on what it is, maybe financial asset or whatever it is. For investments or marketable securities. We'll see the way we can, we'll see the way we can get short. We'll find. So let's go. So for instance, one of the first disadvantages of the balance sheet is that you look at the balance sheet. In some organizations, you might see that PPE is used as cost value here, and another PPE, another same PPE. Some companies are valued at fair value. So one of the disadvantages of balance sheet is that we have different measurement methods for different items in balance sheet. Let's note that different measurement methods for different items in balance sheet. You understand? So for instance, for some items, some are using fair value, some are using cost method, some are using evaluation method, some are using cost method, and they are both right. You understand? They are both right. Are we good? Any question? Okay. So another disadvantage is, look at this from disadvantage. There are some companies like Access Bank, like KPMG, like Deloitte, like PwC, they don't employ anything less than 2-1. I think you are right. Oh, I think we experience hires, I mean, they employ people more than 2-1, they less than 2-1. Am I correct? Even more than even experience hires, they don't employ people who are that 2-1. Even experience hires too. Look at that. I mean, even experience hires, they don't what you call employ people that is less than 2-1. Access Bank, they tell you have to be 22 years old, you have to have 10 years experience, and you have to be passing 2-1. How? You understand? So those are the things we see. So the thing is, even if you have an organization, like maybe I remember there was a time that they said Dangote was employing even PhD holders as drivers. Is that true? I don't know how true it is. Is that true?
They applied.
People apply that. Okay, people apply, not that he was not employing them. Oh, okay, that's fair enough. So how do you go about that? Not that they tell you that they don't employ what is it called? They don't employ anything less than PhD holders. So there are some organizations they tell you that it's only CFA chartered holders you want to employ in our company. Or the only chartered accountants, even as cleaners, chartered accountants want to employ in our company. So the issue now is how do you recognize that kind of stuff in your balance sheet? There's no way you recognize it in your balance sheet. Like, you only recognize, how do you quantify that in your balance sheet? Does it make sense? You get my point. There's no way you recognize it in your balance sheet. It's only first class graduates recognize your company. It's only chartered holders recognize your company. It's only people with BSc first class from University of Liverpool recognize.
It's not only the company.
No, that's not good. You see what Google is showing. Google, that's not good. So at the end of the day, like Google, let me help. We'll still talk about it here. Google is simply purchase price minus net assets of the company. If you have a company like an Access Bank and Intercontinental, somebody will come and say, Access Bank will say, Oga, this is your company that we have looked at, it's worth $50 million. I want to get that. Access Bank will say it's worth $50 million. Intercontinental will get their own accountants. They will value the assets, value the every other thing, and they tell you that, what we value is worth $70 million. So it's the purchase price minus the net asset of the company that needs to be paid.
That's what I'm saying. That goodwill, that what is contributing to that goodwill is not because of the other reputation of the company. Because why would the net asset be 50 and somebody somewhere is ready to pay 70?
Yeah, so that's what I'm saying. So how do you now recognize that it's only CFA holders? How do you quantify that amount and put it in your balance sheet? Or what do you put it?
That was what the goodwill is recognizing.
Okay, so how do you recognize that person as okay? You only recognize the first class from Harvard.
So of course you can't differentiate it.
Yeah, so how do
you be able to say, but the goodwill has passed everything together?
So how do you now say this is goodwill? You bring in a first class guy, how do you put that money and say this is goodwill?
Because like if you are bringing in CFA chartered, CFA holders, chartered with that, in a way, right, it has increased the value of the company.
No. I can even tell you that some companies even with charter holders and they performing better. Without charter holders and they performing better. No, I don't agree.
If you want to go and buy a company, as an investor, I hear that.
You might even as the owner, any boss to go. If you come into a company and say that you might have to start all of them, all charter holders. Yes, I've seen a company like that the company took over and it sacked all the management board, including any charter holder that was there.
I feel like rationally, you want qualified people, like people with experts in your company, right? So if it's the other way around, then there must be a reason why you are
Yes, because you feel it's some very important advice to your company. So how do you now quantify that amount in your balance sheet? That's it. Yeah, my point. How do you quantify that and say this is the value of the experience people are bringing? There's no way. That's one of the disadvantages of balance sheets. Even to use it, they are even paying. They are for the company owners, they are paying more because you have to make the person comfortable, buy the person car, pay the person salary monthly. But they are expensive money. So it's even a huge expense to you. You understand? So there's no way you can value the you have quantified that human element you have put into the business. I don't know if that's right. So that's one of the disadvantages of balance sheet. We get a good vision so it will clear. So let's see. So what are the what's it called? The uses of balance sheet helps in identifying the liquidity, solvency. That's right. It helps in identifying the liquidity, solvency, identifying the liquidity, solvency, then ability to make distributions to shareholders. Identifying liquidity, solvency, then ability to make distributions to shareholders.
What
Liquidity, solvency, then ability to make distributions to shareholders. Yeah.
that's the big
Yes, if you want to make money to your shareholders, that way you do it. Very good. Any question? So what are different what is it called? Different ways in which you can report your balance sheet. There are basically two ways. It's either you use a classified or a liquidity-based balance sheet. So for companies like banks, they use liquidity-based balance sheets. They start with the most liquid. Which the most liquid in balance sheet is what? Cash. So if you are working in a bank, you are working in all these financial investment firms, they use liquidity-based balance sheet. So they start with the most liquid asset, which is cash, and cash equivalent. And that's how going down and as it gets the least liquid asset. I would say that. I would say that.
So liquidity based what?
And classified. So the second one is classified. Classified is you group all non-current assets together, group all current together, you group all non-current liabilities together, and you group all equities together. That is what your classified based balance sheet. Classified based balance sheet. Very good. So you group all current assets together, group all non-current assets together, group all current liabilities together, group all non-current liabilities together. So what you have is a classified based balance sheet. So the next step is now, let's take each one of these items one by one and see how they treat it in the balance sheet. Like I said, there's no way they will ask you for a full balance sheet to solve. It's just all these items will ask you to go about it. I would say that. So let's go. Let's go. So the first one is what? Intangible assets. Intangible assets. Intangible assets. So how do you go about it? Intangible assets. Intangible assets. So what are intangible assets? What are intangible assets? Who wants to help? So when we're in secondary school, we say intangible assets are assets we cannot see, feel, or touch. But let's put it in a proper context. So intangible assets are non-monetary assets that lack physical substance. Intangible assets are non-monetary assets that lack physical substance. Intangible assets are non-monetary assets that lack physical substance. So there are basically two types of intangible assets. There are basically two types of intangible assets. It is either identifiable intangible assets or unidentifiable. So next slide, identifiable intangible assets. Please let's take note. Identifiable intangible assets are assets that can be acquired separately. And has limited life. Are we together? It can be acquired separately and has a useful limited life. When we say limited life, it could be 5 years, it could be 10 years, it could be 11 years, it could be 20 years. Once it has a useful limited life, we say it is identifiable and can be acquired separately. And can be acquired separately. Are we good? Any question? So let's look at examples. One of the very good examples we talk about is we can talk about trademark. What is it called? Trademark, which one again? Patent, copyright, and so on. I don't know if you remember Cynthia Morgan and P Square. Who remember the story? Yes, I don't remember the story. See, in Nigeria, we tend to put emotions into business. Yes, we put emotion into business, and that's one of the things that affect us. So this is my brother, come and work with me. This is your life to be like that. You understand? If you want to give that your brother and you give the person money, let the person go. But if you bring the person into your business, the person 8 o'clock, the person will resume 10 o'clock and tell you that I want to get more. I have a brother that one day that you should be happy, you understand? Before you meet now, emotions will start setting you. Before you meet now, they just call one really MB for you to go and you are here with your family now. Let them let family money go outside. You understand? Those are one of the issues we have as people. We put emotions into business. And that's one of the things P Square and Cynthia Morgan. When Nigerians heard, they were like, P Square is cheating Cynthia Morgan. It's this one. So this is it. When they first started, they were like, okay, P Square will give you this name, Cynthia Morgan. And it's just an example. Just like, okay, so every show you make, you'll be collecting 90%, you take 10%. We'll give you a car, we'll give you every other thing. Will promote your show, will take you everywhere and so on. You understand? And because maybe Cynthia Morgan was so much in the list and so many other things, you saw the offer, the creative, stage were nice, you give a house in Lekki, this and that. You understand? So she took up the offer. You understand? And the offer will last for maybe 10 years. The offer, if you don't pay you, you won't take it. So probably in her career, she not so that, I've increased to start making money. And what is like only 5 million or 10 million, for instance, per show, she's getting only 10 million. And look at 90%, they are getting 9 million, she's getting 1 million. And she now feels cheated when she spoke with some of those staff and said, they are cheating you. You are not saying it now. But it's agreement. You saw the letter before you signed. So why are you now angry now? So that was one first issue. People, when she publicized it, people heard and were like, this way is wicked, this is agreement. Do you understand? It's agreement. So people sat down and agreement. She signed. Nobody forced her to sign. Except for other things we do for free or something like that. And those are one of the things we have in Nigeria. We've had so many cases like that of issues. I don't know if you guys remember Lee Kesh. Lee Kesh, I used to sing with Olamide that time. I remember Lee Kesh, or you don't listen to music. You will focus on safety. So, Lee Kesh, it's an agreement. It's just, okay, I will promote you for maybe 3, 4, 5 years. Once you are done, you leave YBNL. You understand? You leave YBNL, go and create your own. It's agreement. And probably we share the money 50-50. I'll be taking you everywhere. It's agreement. Do you understand? So that is what we are talking about. Identifying intangible assets. Once it can be acquired separately and has a limited number of useful life. Does that make sense, everybody? So how do we choose identifying intangible assets? Now, IFRS. IFRS says, so the thing you need to watch out for, don't watch out for goodwill or whatever. Once you are told that it can be acquired separately and has a number of useful life, what will you treat it as? Identifiable intangible. Whether it is goodwill, patent, copyright, or whatsoever. So let's write. So IFRS 6, someone was saying.
But the one item will be identifiable, identifiable intangible.
So whatever they call it, let's say they call it goodwill, they call it patent, or whatever they call it, what matters to me is the definition of it. Once they're able to identify that it is okay, can be acquired separately and what as a separate useful that you treat it as identifiable intangible asset. So IFRS states that if it is identifiable intangible, let's say this is the way your questions will come out. They just tell you identifiable intangible, how do you treat it? Have you? IFRS says that you use cost or evaluation model. US GAAP says that. So when at what point do you use evaluation model? The evaluation model can be used if we have an active market for that intangible asset. Let's note, evaluation model can be used if we have an active market for that intangible asset. So active market is like, okay, we have somebody, you have a market that says that, okay, this is what dollar is worth today. This is what intangible asset is worth today. And everybody agrees on it. Not that somebody can go and bring one value from somewhere, that person bring one value from somewhere. I would say that. Any question? Any question? Okay, so while US GAAP says that you can only use cost model, US GAAP says you can only use cost model. US GAAP says you can only use cost model. Only use cost model. So let's move. The next one is identifiable intangible, unidentifiable intangible asset. Unidentifiable intangible asset. If there's any questions, stop with this. Please stop it. Unidentifiable intangible asset. Unidentifiable intangible asset. Unidentifiable intangible asset. So this cannot be acquired separately and have unlimited useful life. 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 This cannot be acquired separately and have unlimited useful life. The best example we can do is goodwill. For me, I'm not telling you that if you see a goodwill that has a limited useful life and can be acquired separately, how do you treat it? Tell me. Please, let's watch out for you. Watch out for you. If I give you goodwill and say it has a limited useful life and has what can be acquired separately, just so that you treat it as what? Identifiable intangible assets. So unidentifiable intangible assets cannot be acquired separately and they have unlimited life. Are you good? Any question? So let's go. So identifiable assets or intangible assets, that's right. Intangible assets that are created internally, that's right. Intangible assets that are created internally. Intangible assets that are created internally. Intangible assets that are created internally. Example of asset created, intangible asset created internally is research and goodwill. Research and development. Intangible assets that are created internally. We have research and development. So how much is USD as at today in Nigeria? As at Friday, what do you do? 1 minute. That's black market, I mean. General, that's good. I thought you said that dropped 1.6. Is that true?
I think both are 1.7 something.
1.7 something. Okay, so examples research and development. So under US gap, under US gap, under US gap, under US gap, you expense both research and development stage. Under US gap, you expense both research and development stage. While under IFRS, you expense research stage, then you capitalize developmental stage. Capitalize developmental stage. Good. US GAAP, you expense both research and development. While IFRS, you expense research stage, then you capitalize developmental stage. You expense research stage, then you capitalize developmental stage. You expense research stage, then you capitalize developmental stage. Good. So, unidentifiable intangible assets are tested for impairment annually. We test it for impairment annually. That's right. Unidentifiable intangible assets, we test it for impairment annually. Test it for impairment annually. Test it for impairment annually. Test it for impairment. Test it for impairment annually. Good. Test it for impairment. So what you don't identify, you test it for impairment. So IFRS and US GAAP agrees that once you see this cost, you expense them immediately. What are these costs? Once you see this cost, you expense them immediately. I don't know if you can see my screen anymore.
Sure. I do.
So IFRS and US GAAP agrees that once you see this cost, you expense them immediately. So just remember this acronym STARS. Starts. Yeah. Starts. Just remember this cost. So whatever you are doing, once you see this cost, you expense them immediately. What is the S? S is the startup cost. Startup costs. Startup costs. Startup cost. Once you see this cost, you expense them immediately. S is the startup cost. S is the startup cost. Very good. T is the training cost. T is the training cost. A, admin. The first A is admin. Admin overhead. Admin overhead. The second A is advertising and promotion costs. Advertising and promotion costs. R, relocation and reorganization. Relocation and reorganization. While the last is termination cost. Termination cost. Termination cost. So startup
Relocation and
reorganization. Relocation and reorganization. relocation and reorganization. So once you see this cost, whatever you are doing, you expense them in. So for instance now, there are startup costs in which you are needing
What's the
to
last?
termination costs. Termination costs, you expense them in. For instance, startup costs, you are organizing, you are just starting up, doing this and that, paying this amount, and getting your CAC, getting whatever, all those costs you expense them in. Termination costs, training costs. Training costs. Once you are training the staff, you are doing this, you are doing that, what you expense in. Admin overhead, all those admin costs, every other thing that relates to the business, you expense them in. Relocation and organization, you are moving the staff from Abuja to Lagos, from Lagos to London, from Lagos to Dubai, you expense those costs in. Lastly, termination costs. Once you see any cost, like you are terminating a contract, any other thing like that, you expense it. Are we good?
Advertisement and what?
Yes, advertisement and promotion. Advertisement and promotion costs. Advertisement and promotion costs. Any questions? I see startup costs, expense. Stats, just know like this thing, stats. Stats. So, like we were saying, goodwill, Abi. So let's quickly talk about goodwill. So, goodwill results from acquiring another business. Once you are acquiring another business, it results. Abi, goodwill is the purchase price when the purchase price is greater than the value of acquired company's identifiable net assets. You understand? So, the purchase price you are willing to pay, Abi, and the assets minus liability. So the asset when you do your liability, it give you the identifiable net asset. So once you subtract your purchase price and your identifiable net asset, you get what is called goodwill. So goodwill is not as a result of having reputation or whatever. Are we together? Is that fine? So that is, let's note this. Once you hear goodwill is created internally, once you create goodwill internally, I will say that when there is goodwill that is created internally, it should be expensed. Expense as employed. The best thing. Goodwill that is created internally, you expense as employed. So one of those ways in which accountants can be fraudulent is through goodwill. Do you understand? Can be fraudulent through goodwill. When we get to the last chapter, I'll tell you some of those ways in which accountant can be fraudulent. One of those things they can do in which they can actually make unrealistic gain for themselves. If they are an accountant, one of those ways in which you can say an accountant making money for himself. Do you understand? So that is true goodwill. You can use goodwill to create unnecessary income. So once you see internally generated goodwill, you expense it. Internally generated goodwill, you expense it. Internally generated goodwill, you expense it. Are we good?
So,
Yes.
like, oh, I was trying to write it down.
Yeah.
Oh, it's fine. Okay.
Internally generated goodwill, you expense it. So let's continue. So that is, let's quickly talk about another one, which is PPE, property, plant and equipment. Property, plant and equipment. Property, plant and equipment. So property, plant and equipment are tangible assets, right? Property, plant and equipment are tangible assets. These assets you can save with your property. So they include motor vehicle, buildings, and so on. Property, plant, and equipment are tangible assets. So they include those are like 9 years. Heads are very quiet. So they include PPE, motor vehicle, and so on. So how does IFRS report it? It says IFRS uses cost or evaluation model. Cost or evaluation model. Cost or evaluation model.
Sorry, I don't see.
IFRS uses cost or evaluation model. For PP, property, plants, and equipment, IFRS uses cost or evaluation model to value property, plant, and equipment. IFRS uses cost or evaluation model.
Furniture and fittings model.
Yes.
What of office equipment?
Office equipment, yes. You can put it on like property, plants, and so basically machines and so many other
A company that does not use, okay, whatever this argument, like maybe an fintech, of course, you don't use machines and all of that. What are the things that are don't like?
and if they don't have PPE, you don't have to prepare anything. You don't have PPE. Some companies have, so there are some companies have done, have prepared account for all these intellectual guys, all these intellectual people that do, what is it called? That do software, yes. So basically, they don't have any assets. There's nothing, they don't put anything in the balance sheet. They don't have to do assets. And it depends. You know, it also depends on the companies. There are some companies that depends on the level of the amount of money. If you check your handbook, you specify that, if the asset is below such amount of money, you expect it to be. There's a threshold for capitalization. So for instance, now you are in a Chevron or Shell, even maybe a laptop, you might expect it to be a laptop or maybe 700,000. You might expect it, you might say that the asset, the recognized asset from as high as maybe minimum of 5 million. It is above that, that's where they start calling assets. If not anything 5 million, the expense is million. But in a small company like us, like that, even to some maybe 5,000, 10,000, you might recognize as an asset. So it depends on the company. So some company might say laptop of 250,000, now the kind of my expenses immediately. There's a threshold for capitalization. Those are things we need to know. Basically, laptop, yes, you can recognize an asset, maybe 5 or 4 years. And once it is done with 5 useful life years, you will probably write it or probably sell it. Can I continue? Okay, so where do we stop? So property, plant, and equipment cost or evaluation model. Why US GAAP says we treat it as cost modeling. US GAAP says we treat it as cost modeling. US GAAP says we treat it as cost modeling. US GAAP says we treat it as cost modeling. So the next one is what? The next one is what? Investment property. So what do you understand by investment property? What do you understand by investment property? Investment property. What do you understand by investment property? Who following? Who are following? If there's anything that is of concern to you, please let me know. Investment property. What do you understand by investment property? So investment property are property you probably buy to generate income for you. For instance, now, I give a very good example. People like ExxonMobil, when the downstream was still booming, they were making crazy money from downstream. What they did was they just went to buy properties everywhere in Nigeria, in Ikoyi, in Lekki, everywhere. Now their other income alone covers is more than their gross margin. You understand? If you want to invest in like in Total, their share price is very high. Like the company that is still coming, you understand? Their share price. Whether they make loss or not, they will definitely be getting there because they have other income that is. You understand what I'm saying? They have other income that's covered their gross margin. So investment property are properties you probably buy in any place to generate other income that is different from what you do actually and generate other income. So one of the examples of investment property. So under IFRS, let's go. How does IFRS treat it? Please, who wants to try? Investment property. Investment property. Anybody else to try? So IFRS uses cost or fair value. Please let's take it. Cost or fair value. Good. Why US GAAP? US GAAP believe there's nothing like investment property. There's nothing, so they don't record investment property in their books. Yes, let's take note. US GAAP believes there's nothing like investment property. So they don't record it in their books at all. At all.
Why would they not treat it?
You can put it anywhere, but not just as investment property. Just find a way to categorize it. You can put it as probably deferred income or something like that. Get what I'm saying, but not probably as investment property because they believe that a fraudulent way can be manipulating, make crazy money from it. So there is nothing like investment property under US GAAP. Are you good? Any question? So let's go. So the next is what? Financial instruments. Financial instruments. So please, let's take note. I have to write here. So there are two ways: IFRS, financial instrument, IFRS, and US GAAP. So IFRS is saying that you can call it what? You can call it amortized cost. All those treasurers, these are what they do, that they say we are going to have to not listen very well. Fair value through profit or loss. Profit or loss. Then fair value through here. Other comprehensive income, that's what this OCI means. OCI. That is for IFRS. That is what IFRS calls it. Why US GAAP says no, we are not calling it amortized cost, whatever. We call it held to maturity. Are we together? We call it held to maturity. Held to maturity. Trading securities, then available for sale security. Are you good? So it's the same meaning. Even before now, IFRS used to call it health cost, but they woke up after IFRS 9 when they brought in the financial instrument. They changed their name. Amortized cost, but it's the same way in which you treat them. So, you have a balance sheet. How do you treat it under your balance sheet? BS is your balance sheet. IS is your income statement, while OCI. So, even looking at it, everybody, you can see that from this word now. If you use IFRS classification, you can be able to determine the way you categorize it in your books. Look at it. IFRS treats amortized cost, are we together? Amortized cost, I mean, what? Amortized cost. So how would you treat it in your balance sheet? You should be treated as what? So amortized cost is things that held to maturity. It's just the name that you understand. So profit, fair value through profit or loss is same as trading securities, while fair value through OCI is same as ability for sales securities. So now look at the way balance sheet is. Are we together? So balance sheet is saying that if it is a balance sheet item, I mean, balance sheet item, I'll look at it from the IFRS, you can be able to determine every other thing. So how would you treat it in your balance sheet? Talk to me. If you have a security that is classified as amortized, how would you treat it in your balance sheet? You treat it as amortized cost. Likewise, in your balance sheet, how would you treat fair value through profit or loss? Talk to me. It is treated as fair value. In your balance sheet, how would you treat fair value through OCI? It is treated as fair value. So use IFRS classification, then you are fine. Do you understand? But USGAP calls it held to maturity, trading securities, and available for sales securities. I don't know if you get that. So how do we treat it in our income statement? Our income statement, it says that all realized gain, whichever category, goes to your income statement. Yeah, realized gain. Realized gain. Realized gain. Realized gain. I mean, realized gain or realized gain or loss. Realized gain or loss goes to your income statement. I mean, realized gain or loss for all the three categories goes to your income statement. I mean, so if you are saying this transaction is held to maturity, if you are saying it's held to maturity, I'm not following anyone. If you are saying this transaction is held to maturity, there's nothing like unrealized gain or loss. So there's nothing like unrealized gain or loss. Does it make sense? So held to maturity means you are investing in an, that's right, held to maturity or amortized cost. You have the intention and ability to hold to maturity. Held to maturity or amortized cost. You have the intention and your motive is to hold the security to maturity. You are investing in an asset or a financial asset and it is for 5 years and you have to hold it to maturity 5 years. That is your motive. You understand what I'm saying? You want to buy a financial or a marketable security and your motive is to hold to maturity. That is your motive. That's your motive. Are you sure? That is your motive. That is the reason why you are investing in this, to hold to maturity. Are you sure? So automatically there will not be unrealized gain because you are holding to maturity. Your motive is to wait till the end of the 5 years, collect your profit. So the only thing you can get is realized gain. There cannot be unrealized gain. That's weird. You understand what unrealized gain is? I mean? Unrealized gain is probably at the end of every year, you have valued the asset, what it looks like. You have valued the asset, what it looks like. Yet you have valued it yearly, what it looks like. So you have to calculate unrealized gain, unrealized loss. But since your motive is to hold to maturity, so why would you be carrying unrealized gain, unrealized loss again? You get my point. So there is no unrealized gain, unrealized loss. So
That's under okay, both IFRS.
Both IFRS and yes. So it's the same treatment, it's just the name that is different. But looking at IFRS, what me I used to remember, once I look at IFRS, I can deduce how I'm going to get how to categorize it. It's the same way. The same.
So let me get it clear. So we are saying that in the income statement, right, securities or assets that are held to maturity.
All assets, all financial assets or marketable securities, once it is a realized gain, they go into your income statement. Whichever one you are doing, whether it is fair value through profit or loss, fair value through CI, amortized cost, whether it is a realized gain or realized loss, it goes into your income statement direct.
So, but you said something that for held to maturity, you can't have a realized.
You can't have unrealized gain or loss. unrealized gain or loss, because your motive is to hold till the end of the month or okay, so this is it.
So until maturity,
Before you can before you can know the amount that is worth. You get what I'm saying now?
so what of companies that revalue their assets?
If you revalue, you cannot revalue held to maturity because your motive is to hold to maturity. Okay, this is it. So once an auditor comes to it, we ask you, what is the motive of you holding this maturity? Because accountants can be fraudulent. They might want to switch from this one to this one and make crazy money. But I think one is paying better. You get, like the way now, this dollar is going up now. You understand? If you can be smart enough and say, no, my motive is not to hold to maturity again. Let me quickly sell because dollar has come up and make money. But they've known the motive. So if you do that, it's wrong. It's not allowed. Your motive is to hold the USD 2020, 2030.
So are you saying if I have an investment?
No, why? That's why we're here.
I'm actually a treasurer and this thing is doing me.
Oh, yeah, talk to me. Hey, let's go. I want to talk to you. Now I want to talk to treasurer. Yeah, talk to me.
So if I have an investment, right, that is supposed to run for, let's say, an investment that is supposed to run, for example, an investment.
What is your motive first of all? That's the best in the
For 1 year.
It's to hold to maturity.
Yes, a fixed income investment that is meant to run for 1 year, I want to hold it
To maturity. That's your motive when you want it.
That's the motive. And it's a dollar with fixed dollar investment. Right. So if at the end of every month, because of the
You
fluctuation,
cannot value it.
because of the fluctuation,
You cannot value it. You cannot value it. So once you value at the end of every month, what you are getting is unrealized gain.
yeah,
That's what I'm saying. Once your motive is held to maturity, you cannot value it until the end of it before you can value it.
okay. So if that unrealized gain that you're talking about, right? How do we clear our intention? How do we make our intention that okay, we want to hold to maturity, we don't want to hold to maturity?
Okay, so this is once you buy a financial marketable securities, the first thing the auditor will ask you is what is the motive of you buying this asset?
What if it can change now?
That is it. It can change. When you get to level 2, you will see the one you can run from and move to. It's restricted because they know account like the way you see it now, you can see that the way dollar has gone up, let me sell it in next month.
Exactly. The motive has changed.
The motive has, that's what I'm saying. Because they know that accountant can be fraudulent. You understand what I'm saying? Because you see that you get a better deal if you increase it now. You understand? So if you sell it now, you are in violation of the law. So I don't know if that's fine.
I get what you're saying, but I don't think it's like that.
It's like that too. So that is
Because
what
that's what we do.
that is what I do. You understand? That's what I do.
It's the value at the end of every month.
Yeah, so that means it is not under held to maturity. The security you are carrying is not under held to maturity. You get what? Thank you, sir. You get what I'm saying? So if your motive is to hold to maturity and you sell it, you are in violation of the law.
Okay. So it's under what? It's under
Get extortion. It's legal, yes, we trading securities. So once you have the intention to hold to maturity and you sell it in the week, you are a fraudulent. They will write it back. The auditor will kick it out. You get what I'm saying now? So once you have the intention of holding to maturity, you cannot sell it. Once you sell and they know, hey, you're in trouble. Except you can go and do fraud down. You understand? So now the next one is, since we know that all realized gain goes to your income, the next one is unrealized gain. And we know that held to maturity, there is no unrealized. Somebody say something online. Somebody else say something online. Okay. So unrealized gain now. So the unrealized gain, we know that there is nothing like unrealized gain for held to maturity. The next one is unrealized gain. So unrealized gain under profit or loss. Under profit or loss, unrealized gain goes into your income statement. Please let's note. Unrealized gain or loss goes into your income statement. You can see profit or loss. So everything comes into your profit or loss. Do you understand? Everything comes into your profit or loss. That is where it goes. You understand? So let's go. So fair value through profit or loss. That's right. So you fair value through profit or loss. you have the intention, your motive of buying that security is to sell in the nearest future. That is the motive of buying that security. You are buying that security and say, oh, more, don't go up. Call your treasurer, sell it now. You understand? That is your motive of buying that security. I don't think that's fine. Makes sense, I mean? Your motive is to sell and sell your opportunity. You watch it. More is coming out, don't sell that. It's going on, or more, don't hit 2,000. Sell now, sharp. Insider information is going down anytime soon. Hold on. You understand? So that's so unrealized. So once you are doing that every month, like you are talking about, that's what your value is now unrealized to know the value of the security. While the last one, fair value through OCI, you neither have the intention or the ability to sell the rest of the so it is left to you. You can decide to hold to majority or you can decide to sell as the Lord leads you. Once you look up, there's unrealized gain. So unrealized gain at that point goes into your OCI. Unrealized gain goes into your OCI. Interesting. Makes sense, I mean?
So that is on that fair value. Both realized gain and unrealized gain.
Fair value through profit. Yes. Fair value, unrealized and unrealized gain, other profit or what goes into your.
So what available to sell?
Available for sale securities. So it's the other name, like I said, IFRS calls it amortized cost, fair value to profit or loss. That's what we all carry around. You can relate that. But in US GAAP, before now, IFRS Nigeria used to carry out to maturity at trading security, but it was IFRS that now decided, no, let's change this to this, let's change this to this, let's change this. I don't know if it makes sense. So that is what treasury is. That's what those things. And that in itself is mark to market. Mark to market is what the market is saying. When you say mark to market that security, that is what the market is saying as of today. Say it at what the market is saying as of today. That's mark to market. However, let's note this. The question will come out like this. Just note all this in your phone. Any questions? Any question? So there are other things too. We could have long-term financial liabilities. Long-term financial liabilities are liabilities that are over 1 year. It could be your loan, it could be your every other thing. Long-term financial liabilities. So we have deferred tax liability. We'll talk about deferred tax liability later on. So, remember we talked about common size income statement, right? Common size income statement. So, we want to help with common size balance sheet. What do you mean by common size balance sheet? Like I said, once you are doing a common size balance sheet, you are bringing the two companies to the same level. You've removed the size effect, right? You remove the size and you are bringing it to the same level. So what's common size balance sheet? Common size balance sheet. Thank you. Please let's look. So you divide each line item by your word, total assets. Please let's write. You divide each line item by your total assets. So I think it's fine, right? Yeah, let's go on. So resources controlled by an entity as a result of past events is called what? Assets. Thank you. So equity equals, equity equals assets minus liabilities. So we are fine. Is it correct? Okay, thank you. So if you have any issues, please stop us. So number five and 6. Okay. Distinguish between current and non-current assets of the balance sheet. What are we doing? What we distinguish current, non-current, current liabilities, non-current, and what are we doing? Classified. Thank you very much. That's a classified balance sheet. Thank you very much. So the most likely common to use a liquidity-based balance sheet is what? Bank. Thank you very much. This class is wonderful. This class. Thank you. So number seven, an example of a contra assets account. Contra asset. Remember the word contra asset. So contra is a subset to the main account. Let's say for instance now, contra is a subset to the main account. Like you have a revenue, returns on goods is what is a contra account. You have a fixed asset, an accumulated depreciation is a contra account. Have you? You have a trade receivable, allowance for doubtful debt is a contra account. So an example of a contra asset is what? Depreciation, sure. Depreciation.
I think the last one said allowance for that one.
Thank you. Thank you. See, because so why I'm saying that is that you know this one is an asset, I mean, some are contra in income statement, some are contra in balance sheet. A depreciation expense is just on its own. Let's say we're given accumulated depreciation, and that would have been a contra to a balance sheet. A sales return is a contra to what? Income statement, revenue, I mean, while allowance for doubtful debt is a contra to what? A fixed asset, I mean. Sorry, contract towards receivables, I mean. So that's an asset, I mean. That's why we are going for C. I don't think that's fine.
But they didn't specify whether it's asset or.
Yes, it's there. It's contra asset. Contra asset. So we have to be very careful. Contra asset. Good job, everyone. Good job. Let's go. Let me see. So let's look at this together. Let's look at this together. Let's look at number 16. Financial asset classified as credit security. I've given you the answer. But yeah, check your note, but at least for now. Next time, I'm not allowing you to check your note. Yeah, check your notes. Financial assets unrealized gain and loss are recorded here. Yeah, talk to me.
Income.
Is where?
B.
D. That is that. And that is it. So if you know it forever. You understand? And once you get to level 2, you now see that the way accountants are fraudulent, the way they can want to switch from health to maturity into an intake, giving you the rules are there. I didn't talk about the rules because it's not in your evidence. You understand? Don't waste your time once it's not in your evidence. That's what I didn't talk about. So if you move from one category to another, there is rules that no, it's not allowed. You understand? So let's look at number 17. Number 17, anyway. Classified as available for sale. Available for sale. That's fair value through CRE. So from there, you should be able to. Our unrealized gain and losses. So how do we recognize unrealized gains? We agree, everybody. Somebody says C. Thank you. Perfect. Thank you. So let's look at number 18 to round it up. And we'll now move into cash flow. Number 18. This class is wonderful. Number 18. So if they are held to maturity, how do you recognize unrealized and unrealized? And that was thank you. That was our argument. Thank you. Makes sense, I mean? So like he said, no, he said they are not recognized. I think that was our argument. I was just emphasizing our argument earlier. Makes sense. Please just understand the table very well. They are fine. Like I said earlier, the number of times you use your calculator for level 1, sorry, is minimal. Understand the tricks, and you are fine. Understand the tricks very well, and you are fine. Let's go. Cash flow. This is a very, very important topic. Cash flow. So cash flow provides information about receipts and payments during an accounting period. Cash flow provides information about receipts and payments during an accounting period. Receipt and payment. So cash receipt and cash payment during an accounting period. Cash flow provides information about cash receipt and cash payment during an accounting period. So they assist users to evaluate liquidity, solvency, and financial flexibility. They assist users to evaluate liquidity, solvency, and financial flexibility. They assist users to evaluate liquidity, solvency, and financial flexibility. So basically for a cash flow, it's only cash items that goes in. Have you? Cash items. So there are basically two ways in which you can prepare your cash flow. It's either you use direct or indirect method. Okay. So it's either we use direct or indirect method. So direct method is the best, but most people use indirect method. Direct method is the best, but most companies use indirect method. So direct method probably summarizes everything from your revenue, goes through your revenue, your cost of sales, and all that to get to your profit. While your indirect method just recognize everything under your profit, and they start working from there. Are we together? So direct method recognizes from your revenue and so on. While your indirect method starts with your profits. And after your profits, then they start recognizing others. So the best method to use is your direct method, but most companies use indirect method to prepare their income statement. So there are two methods, direct and indirect. So under each of these methods, we could either have operating, investing, or financing. So operating activities has to do with the day-to-day activities of the business. Let's take it. Operating activities has to do with the day-to-day activities of the business. Operating activity has to do with the day-to-day activities of the business. Operating activities has to do with the day-to-day activities of the business, while investing activities has to do with you recognizing acquisition and disposal within the period. As investing activity, while financing activity has to do with changes in capital structure. So your movement between equity, debt, and so on, changes in capital structure has to do with your financing activity. So there are two methods in which you can prepare cash flow, direct and indirect. Each of these methods has operating, investing, and financing activity. Operating activity has to do with your business, the daily activities you do. Investing activities has to do with what? Investing activity has to do with acquisition and disposal of fixed assets, while financing activity has to do with financing activity has to do with changes in capital structure. Any question? So who wants to help? Under IFRS and US, how do we treat this item? Please, let's take a look. Under IFRS and US, how do we treat this item? So, you can't see my screen. Okay, I will mention it so in case you miss it. So I want you to help me. I want you to help me with these things. Yes, I want you to help me with these things. How do you recognize these things under operating, investing, or financing, under IFRS and US GAAP? Dividend received, dividend paid, interest received, interest paid. Anybody wants to try? Please, IFRS and US GAAP. How do you recognize these things? It's very, very important. Dividend received, dividend paid, interest received, interest paid. Anybody wants to try? Just somebody try it quickly so we can go ahead. Yeah.
Dividend received, investing,
Okay, dividend received, investing. Under which one? IFRS or US GAAP? IFRS. So you are saying dividend received is investing activity. Okay, dividend paid.
trading factors for that, financing,
Financing. Interest received.
interest, investment,
Interest received is part of investment.
interest paid, interest paid, operating.
Operating. Okay, what about US GAAP? Anybody else wants to try? Okay. Because of time, like I say, it's the smartest people that pass this exam. Just be smart. Things you just know what to do and you are fine. What people will be struggling, you know how to tackle it and you move on with your answer and you are fine. So just remember that what's common with this one? Dividend receipt, R is common, Abi. Dividend paid, P is common, Abi. Interest received, R is common again, Abi. While dividend paid. So let's summarize which is R and P, Abi. Does it make sense, everybody?
Yeah.
So just remember for IFRS, it is either ROI or POF. So interest received or dividend received can either be operating or investing. While dividend paid or interest paid can either be operating or financing. Please let's take note. It's very important. IFRS, ROI or POF. Dividend received or interest received can either be operating or investing, while dividend paid or interest paid can either be operating or financing.
So what is the purpose of
Dividend paid
dividend paid?
or interest paid. Dividend paid or interest paid can either be operating or financing.
While interest received
Or dividend received can either be operating or investing. Are you fine? While for US GAAP, everything is under operating. Everything is under operating except dividend paid is under financing. So any dividend paid, that is financing. So everything is under US GAAP, everything is categorized under operating except dividend paid, which is under financing.
Without other means,
Dividend received or interest received. Dividend received or interest can either be operating or investing, while dividend paid or interest paid can either be operating or financing. Are we fine? Can I go ahead? Those online, are you fine? So we said that only cash item goes into your what? Cash flow. Cash item. So if we have non-cash operating activity, non-cash investing activity, or non-cash financing activity. How do we treat them? Let's start with the non-cash operating activity. So how do we treat the non-cash operating activity? What examples are non-cash operating activities? What's a good example? Non-cash operating activities. Non-cash operating activities. Everybody wants to give an example of non-cash operating activities. Non-cash operating activities. Everybody wants to give an example. Yeah, now who wants to give an example? Anybody wants to give an example of non-cash operating activities? So example are depreciation, depreciation, amortization, impairment. So let me give you a check for cash flow. Let me give you a shortcut for cash flow. Whatever you are doing in your income statement or balance sheet, you do the opposite in your cash flow. Let's say for instance now, in your income statement, depreciation, what do? You subtract it, I mean, when you get to your cash flow, you go and add it back. Does it make sense? If you are in impairment, if you are subtracting impairment, If you are subtracting, what will you do in your cash flow? You go and add it back. Other income, your income statement, you are adding, you go and subtract in your cash flow. So you do opposite of what's in your income statement or balance sheet in your cash flow. So I don't know if that's fine. Is it fine? So no cash operating activity, something like depreciation, amortization, and payment. So how do you treat it? How do you treat it in your cash flow? How do you treat it? Yeah, so items like non-cash operating activities, you treat it, you add it back, or you subtract in your operating activities. Operating activities. Any questions? Very fine. Very fine. Any questions? Any questions? Very fine. Any question?
So non-cash operating activities.
No cash operating activities. You treat it in your operating activities.
And you add it down. We add it back, right?
Yeah, it depends. If you are subtracting in your income statement, you add it back. If you are adding in your income statement, you subtract. Yes, please go ahead.
Yeah, I think that. But it still goes to your cash flow.
Yes, it goes to your operating years. Thank you. So non-cash investing and financing activities. So how do you treat it in your cash flow? Non-cash investing and financing activities. What should we get example? Non-cash investing or financing activities. So a very good example is, for instance, if you are owing a particular person, instead of the person collecting cash back, now tells you, instead of me collecting cash, I'm going to take maybe 10% of the equity. I'll take 5%. So it's just like debt for equity. Or probably you are swapping assets. You give me Benz, I give you Toyota 2019. You give me Benz 2012, I give you Toyota 2019. You are swapping assets. You understand? So those are non-cash investing or financing activities. So when such, let's take it, when such items happen, when such non-cash investing or financing activity happens, it must be disclosed in your footnotes. It must be disclosed in your footnote, but not recorded in your cash flow. It must be disclosed in your footnotes and not recorded in your cash flow. It must be disclosed in your footnote and not recorded in your cash flow. It must be disclosed in your footnote and not recorded in your cash flow. Are we fine? Okay, so let's see. How do we calculate direct and indirect cash flow? Direct and indirect cash flow. Direct and indirect cash flow. Are we good? Direct and indirect cash flow. 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 How do you recognize direct and indirect cash flow? So basically, what differentiates between direct and indirect cash flow is just the operating activities. Operating activities. So investing and financing activities are the same. Take note. Investing and financing activities are the same. And financing activities are the same. So what differentiates between direct and indirect is the operating activities. Are we together? So investing and financing activities are the same. Are we together? Investing and financing activities are the same. Any questions?
So what differentiates them with
Operating activities, yes. So we now look at the operating activities, look at investing and financing activities together. So let's go. So how do we go about operating activities for direct method first? Operating activities for direct method first. Are we good? Are we good? Any question? Please, if there's any question, please ask me. If there's any question, please ask me. Don't hesitate to ask me. So investing activity. So just remember the first thing is, if cash is coming into the organization, is what is an income, Abi? That is sign. Please let's take note of this sign. Plus, if cash is going out, is an outflow, Abi? That's a negative. Abi? If cash is coming in, it's a positive. If cash is going out, it's a negative. Abi? So just remember C short T. Abi? C is what? Cash collected from customer. If you collect cash from customer, what's that? Is that a negative or a positive? Because cash is coming in. Please, the first thing you need to do is put the sign positive. Then you start doing the rest. Cash paid to supplier.
Negative.
Thank you, sir. Cash paid to supplier. Cash paid for operating expense.
Negative.
Operating expense. Negative. Cash paid for taxes. Negative. Cash paid for interest expense. Are we fine? So the first thing you need to do is put the sign. Once you put the sign, you are fine. Are we together? Please take note of this is the operating activity under direct method. Are we good? So the next thing is, how do we go about this? The first thing is, look at this. You know, we say whatever you do in your income statement or your balance sheet, you opposite to your cash flow. If, for instance, let's say in 2010 and 2011, your receivable is what? Let's say it's 15, and it has increased to 20. That's increase in current asset, have you? Increase in receivable, increase in current asset, have you? So if there is an increase in current asset, it's a positive to you, Abi, because your asset has gone up. Abi, if there is an increase in current asset, it's a positive to you. Your asset has gone up. Abi, so what will you do in your cash flow? You subtract. Thank you, sir. So what me I used to do there when I was doing my ICANN, I just knew only this one. It was later when I started CFA, I knew that, so the reason why we are subtracting is because you do the opposite in your cash flow. You understand? But for my ICANN, I don't remember only this one. You understand? So once I remember only this one, I just turn the other ones upside down. So if there is a decrease in current assets, you add. If there is an increase in current liability, you add. If there is a decrease in current liability, you subtract. You understand? But if you can relate it to that one that we know about, what's it called? That an increase in current assets is a positive in your balance sheet, so you go and subtract in your cash flow. Do you understand? Are we good, everybody? Any questions? Any question? Okay, so let's look at a very good example. Okay, so let me run up so you can see. Just remember C short T. Can I run this off? Okay. So this is automatically a direct method. Can see, this is a direct method. So let's do this together. Air Communication Limited provides equipment sales and installation of telecommunication equipment. L also provide maintenance for systems installed under service contract. Revenue from maintenance contract is deferred and recognized over the life of the contract. Selected financial sectors 2012, 2001. Income revenue 2018. Balance sheet extra, account receivable from 900 to 500, you can see from 500 to 900. Then on end revenue, which is 300 to 1,000. What is calculate the cash received from customer? So cash received from customer, how do you treat that? How do you treat that? Cash receivable. Thank you. So what's the first thing? Thank you, sir, for doing it. Put it sign. Why too fast? Are we looking confused? Are we looking confused? Yes. Eh? Okay, so, and we are going for which year? 2002, I think. So, which revenue will we pick? 2 million, I mean? 2 million. The next one is to move to our balance sheet item, I mean. If there is an increase in current assets, what do we do? We cash flow. And we just note it down. If there is an increase in current assets, what do we do? Minus. So what's the increase? The increase is for how much? 400. So it's going to be minus 400,000. Then if there is, this is a current liability, I mean. Current liability. So if there is an increase in current liability, what do we do? Makes sense, I mean. Is it plus?
So which is on end?
Yes. Have you seen now? On end revenue. Is it like that? Makes sense, I mean. Is that fine? Increase in current liability. So let's write it out. If there is a decrease in current assets, you add. If there is an increase in current liability, what do? You add. I mean, so if there is a decrease in current liability, what do? Subtract. So you can use this on pick it now. So what do? You add. Add about how much? 700,000. So what is your cash collected? What's your cash received from customers? Is it 1.3? Yeah. So this is.
So is this indirect or direct?
This is direct. This is direct. Are you confused? Are you confused? Okay. That's 2.3. So 2.3, Abi? That's 2.3. That is our cash collected from customers. You can see 2.3. Straightforward. You don't need to grab their method, just understand the basics. You are fine. When you see inflow, put the sign first. Pen, once you put the sign, boom, you are good. Then you follow the logic. Like that, like that, like that. Understand the basics. You don't need to cram anything. You know, if you notice, there's no way we've talked about Q formula here. Just understand the basics and you are fine.
So I don't understand how on end revenue is calculated.
Okay, so how? What do you think? What do you think about on end revenue? Talk to me.
On end revenue, it's the revenue that we are able to receive.
Yes.
Revenue is meant to be an
Okay. Okay. See this. You know when we started. Have you watched the income statement videos? When we started, income statement. Okay. We said there are 3 forms of revenue. The one we pay cash for. The one you tell the person that, oh, yeah, my friend, pay later, credit. And the ones that the person has paid you in advance, but has not picked up the goods.
not?
The person has paid you in advance,
Okay,
but has not picked up, so that is contained revenue. You understand? The person has paid you in advance, but has not picked up the goods. So it's a liability to you. If the person say, "Oh, she won't give me my goods," you have to give me my money. You have to return the money back. So you can't. It's on end revenue because the revenue has not been paid. Because later on, picked up the goods. Remember those items we talked about. We said those items before you can recognize revenue. Remember contract. If you watch the income statement, contract, all those things like that. So it's an on end revenue because this person has not picked up the goods. It's a liability to you. You know some guys, they are not very smart. They think, dollar is going on. Or more. Let me go and tie the guy down. He just paid me in advance. Sharp guy. After 6 months, just that this is not me. I'm not buying it. Give me my money. Because you can't recognize such revenue. If you recognize it, you violated the rule. You understand? So it's on end revenue. So you have to return the person's money back. You understand? That's why it's a liability. So are we fine now? Just understand the basics. That's fine.
Gets a higher bar. You cannot do that in Nigeria. It gets a higher bar. Except to buy items.
Even abroad, there are rules. There are times. I've seen people. I've traveled to some places abroad. They tell you that you can book 3 months in advance. If you're not interested, you can tell them they will return you. They will just tie money down on their account until you use it. Understand? So once they see that you are no longer interested, you can just cancel it and they return the money back. Once you have a credit card, you just close it down. Once you got it, you got it back. You can book hotel in advance. Once you are not using it, life is not difficult. You know you can't run it. Your credit card details, everything is there. So when you want to run, you understand? The credit card details is there, everything is there. So once you book it down, they just tie it and that this amount is tied to. Then if you feel like maybe 6 months, I'm not interested again, just cut off the store and that's it. Okay, so let's go. So that is it. Very simple. Makes sense. So that is the direct method. So there are other ones which we will see later when we solve questions. Just understand the logic they are fine. Remember, this is an inflow, it's an income. Put the sign first. Then you need to solve it. Please, the sign matters at this point. The sign matters at this point. So the indirect method is very easy. Indirect method is very easy also. Indirect method is very easy. So you start with your what? Indirect method. You start with your net income. They hide everything under net income. Net income. I mean, you put your non-cash charges. Non-cash charges. Non-cash charges. Abi? Non-cash charges. Abi? Non-cash charges. Then you do your changes in working capital. Changes in working capital. Working capital. Which is your increase in current assets. If there is an increase, you subtract. If decrease in current assets, you add. Then increase in current liability, you add. Then
Same thing with direct.
Yes. But this one is the same thing with direct. But just notice that we start with net income from there. Unlike that one that we start with revenue, purchases and so on. You understand?
Revenue.
You can see supplier, cash collected from what's it called? Cash paid to cash collected and so on. Waiting, cash paid, you understand? So this one is, people use this one because you hide everything under your net income. Unlike that one that you see, oh, so this is how much they actually sold. So this is how much they actually collected from their customer. You see it, it will be clear. So that's why people hide on this one. You understand? So most companies use indirect method. But the best to use is the direct method because it is explicitly stated. You see everything one by one step.
I think IFRS relates indirect.
No, IFRS says everybody knows. Everybody can use anyone there. But the best to use is direct. But most companies use indirect because they hide everything on that net income. Because they will see the way your money is moving. It doesn't make sense. Most of them are like, so this is how much they spent on supply, that one they spent on. It doesn't really make sense. So, decrease in current liability. Like that, Abby? If I'm correct.
This one net income. Is it net profit or gross profit?
No, it's net profit. Once you do that, you get your cash flow from operating activities. Cash flow from operating operating activities. All together, cash flow for equipment. So that's what you mention between direct and indirect. Direct and indirect. So let's go into investing and financing activities. Investing and financing activities. So investing activity, that's right. Investing activity has to do with acquisition and disposal of fixed assets. Acquisition and disposal of fixed assets. Acquisition and disposal of fixed assets. Investing activity has to do with acquisition and disposal on fixed assets. Acquisition and disposal on fixed assets. So how do we calculate our investing activity? 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 So cash from sale, cash from sale of equipment is the historical cost of the equipment, minus depreciation on the equipment, plus gain or loss on the equipment, How together? Historical cost minus depreciation plus gain or loss on the equipment. So how do we calculate this historical cost? How together? This historical cost is the beginning balance of the equipment, beginning balance of the equipment plus equipment purchased. So we are moving into this one now. Plus equipment purchased minus ending balance of the equipment. Ending balance of the equipment. The next one is depreciation. How do we calculate our depreciation? Depreciation is what? Beginning balance of depreciation plus depreciation expense minus ending balance on depreciation. Are we fine? So this is the maximum question you can do on investing activity. Historical cost minus. Yes, I can hear you, sir. Yes, that's what I'm calling it now. So investing activity, investing activity. Okay, it is cash from sale of equipment. So this is it. How do we calculate your cash from sale of equipment? Cash from sale of equipment is the historical cost of the equipment minus depreciation on the equipment plus gain on sale of the equipment. That is cash from sale of the equipment. Historical cost of the equipment minus depreciation on the equipment plus gain on sale of the equipment. And we are now picking each one of them one by one. So the historical cost of the equipment is the beginning balance plus equipment purchased minus ending balance of the equipment. So historical cost of the equipment is the beginning balance plus equipment purchased minus ending balance of while depreciation on equipment sold, is the beginning balance of depreciation plus your depreciation expense minus any balance of equipment, minus any balance of depreciation, minus any balance of depreciation. Okay, so let's look at a very good example. Example 1. I will cover all these investing activities. Example 1. So let's write A Limited shows the machinery and accumulated depreciation balance. A Limited shows the machinery and accumulated depreciation balance for 2021 and 2022. Are we writing? Are we together? Yes. A Limited shows the accumulated depreciation balance for year 2021 and 2022. A Limited shows the accumulated depreciation balance for year 2021 and 2022. A Limited shows the accumulated depreciation for year 2021 and 2022. So in 2021, the machine balance is 80, and in 2022 it is 91. In 2021, machine balance is 80, and in 2022 it is 91. While the accumulated depreciation in 2021 is 25, and in 2022 is 31. It's 31. So the gain on sale of machine is 1.5. The gain on sale of machine is 1.5. The gain on sale of machine is 1.5. And the depreciation expense in 2022 is 7. Depreciation expense in 2022 is 7. While the capital expenditure is 14. Capital expense is 7. While the capital expenditure is 14. How much did the company receive in cash from the sale of it? How much did the company receive in cash from the sale of it? So what we just did is use the same formula. Historical costs minus depreciation of equipment plus gain on sale of equipment. Historical cost. So what's our historical cost? And we tend to calculate our historical cost of machine. It is usually the gain balance plus equipment minus any balance. So our beginning balance the formula for what? Okay, so it's the beginning balance plus equipment purchased minus ending balance. Oh yeah, so what's the beginning balance? Yes, 80 plus what? Plus equipment purchased, which is for the capital expenditure, minus 91, which is the ending balance. So what do we have? With 3. Thank you. So we put the 3 aside. 3. Let's look at the one for the depreciation. It's still the same formula. Beginning balance for depreciation minus depreciation expense minus beginning balance for depreciation plus depreciation expense minus ending balance for depreciation. So what's our depreciation expense? Beginning balance is 25 plus what? Our depreciation expense, which is what? 7 minus our ending balance, which is what? 31. So what do we have? Oh yeah, talk to me. What do we have? 1. Thank you. We have 3 here, we have 1. So what do we do? 3 minus 1, minus 1. So what's our gain on capital? What's our gain on assets? 1.5, So what's our cash from sale of investment? 3 minus 1 plus 1.5. 3. That is how we calculate it.
Well, I don't see 7 or 14.
Yes, I dictated it.
Okay.
I said it. Gain or sale of machine is 1.5, while depreciation expense is 22.7. Capital expenditure is 14. What is the cash from sale of? So we talked about investing activity. Last thing now is financing activity. Financing activity. So we said there are two forms. There is the equity and there is the what? The debenture. I mean, equity and the debenture. The equity and the debenture. Okay, so let's move. Financing activity. So there are two forms. Cash from creditors. Cash from creditors. Cash from creditors. Are we together? Cash from creditors. It is the new borrowings. Cash from creditors is the new borrowings minus principal amount you paid. Minus principal amount you paid. Principal amount you paid. Principal amount. While the other one is the one with equity, it is new shareholder, new cash flow to shareholder. Shareholder. It is your new equity issued. New equity issued. Minus share repurchase. Minus share repurchase. Minus cash dividend paid out. Minus cash dividend paid out. So the cash from creditors is your new borrowings minus principal amount you pay. While the new cash to your shareholders is your new equity issued minus share repurchase minus cash dividend paid out. Cash dividends paid out. Cash dividends paid. So two more things, and we'll round off cash flow. Yeah, two more things.
Cash from credit, new borrowings minus principal amount paid.
Yes.
So how about the interest?
Principal amount you paid. So it depends. So if the principal amount is paid, you know the interest will have treated it. You have treated it. So now, let's move. So we talked about common size income statement, common size balance sheet, have you? So what is the one for common size cash flow? Anybody wants to try? Common size cash flow. Common size cash flow. Common size cash flow. Common size cash flow. Anybody wants to try? Common size cash flow. Okay, so there are two ways in which you can do your common size cash flow. One of them, you express each line item as a percentage of revenue. Let's write. Express each line item as a percentage of revenue. That's common size cash flow. Express each line item as a percentage of revenue. Express each line item as a percentage of revenue. Then number two, express each outflow as a percentage of total outflow. Then express each inflow as a percentage of total inflow. Express each outflow as a percentage of total outflow, or express each inflow as a percentage of total inflow. So whichever one you use is fine. Whichever one you use is fine. Express each outflow as a percentage of total outflow, then express each inflow as a percentage of total inflow. So whichever one you use for the two of them is fine. Whichever one you use for the two of them is fine. Any question? Okay, so lastly, like I said, I said two things. I've said the first one, so the second one now. There's something we call free cash flow to firm and free cash flow to equity. I don't know who has an idea of what free cash flow to fail or free cash flow to fail. When you say free cash flow, should we postpone it next week? Okay, sir.
Free cash flow to fail. Free cash flow to debt. That would be to subtract dividend from free cash flow to fail into another free cash flow to debt. It's the same thing as cash flow statement. It's just
So what does it mean? But I know people have gone to interview very well and say, okay, as you are coming in for the role of investment analyst, it's helpful. What is free cash flow to fail and free cash flow to debt? What will I tell the person?
free cash flow to fail is the cash available.
Cash available. Cash available. Combine free cash flow to equity plus.
The same thing, the only difference between the two is the portion of dividend.
Let me help out. So free cash flow to fail is the total fund available to all providers of capital. Let's note that. Is the total fund available to all providers of capital. Profit is not cash. Let's note that. Profit is not cash. So when you say free cash flow to fail, is the total fund available to all providers of capital. So including debt and equity. While free cash flow to equity is the total fund available to all providers of equity. Free cash flow to equity is the total fund available to all providers of equity. So it's quite easy. It's quite easy. So let's start with free cash flow to fail. Please, this one is very good. We need it to your level 1 and level 2. So remember operating cash flow. You can use this method to remember investing and financing activity. Operating, investing, and financing. Okay, we should wait next week. Let's wait next week. Okay, we'll continue next week. So thank you.